Welcome back to Let's Talk Tax, the show for growth-minded CPAs and real estate pros navigating the ever-changing world of tax. I'm TJ Sponsel. In today's episode, we're breaking down one of the most anticipated pieces of tax legislation in recent years, the One Big Beautiful Bill, and what it means for R&D tax planning. Joining me today is my partner, David Seibel. He's a shareholder in our R&D Tax Credit practice. We're going to unpack the sweeping changes of Section 174 expensing, what's new for small versus large taxpayers, and how this bill opens the door for new planning opportunities. Whether your clients have consistently claimed the R&D credit or paused due to 174 complexities, this conversation is packed with actionable insights. We'll cover risk mitigation strategies, options for amending past returns, and how to get compliant while maximizing benefits in 25 and beyond. Let's dive in. Welcome, David.
Thanks for having me, TJ.
Well, David, it's been a long 2.5-year saga for us, hasn't it?
It has indeed, for sure.
You know, for those who have just joined, have not listened to one of our LTT podcasts before, back in January 23, when it was obvious that we were not going to fix 174 expensing anytime soon, David and I and our colleagues spent a lot of time not only educating our clients on the significance of 174 versus 41, but doing 174 analysis and having to deliver very bad news to clients about the punitive nature of 174 amortization. So I think we'll call it the One Big Beautiful Bill OB3 for today's purposes, so we can be a little bit more brief. But I think we can both, if there was a beer or cocktail, I think we'd be toasting right now because it was a relief, mainly just because our clients. I mean, I think when you looked at 174 expensing, it was just so incredibly punitive to especially small taxpayers.
Oh, absolutely. That's something that was really detrimental, like you said, for a lot of our clients and just a lot of taxpayers in general. A lot of taxpayers had to choose between complying with the law or going out of business. And we actually did have a client that, because of 174, they went out of business because they were a startup. They were specializing in AI way back in 2023 before this big AI boom. Mm-hmm. They were a couple $1 million firm, like I said, just as a startup, and they went out of business because they had a 6-figure tax bill because they were so research intensive, and they just had to close down shop. Yeah. So
and what was frustrating about the whole process is not only were we helping our clients and educating CPAs or assisting them in educating their clients and working with them on the 174 analysis, we were trying to do our part in DC. We were part of a coalition that was trying to educate lawmakers on how punitive it was, and everybody agreed it was punitive.
Yeah, once everybody learned actually what it actually meant, and that it wasn't just the proverbial large companies that typically do R&D. That was more of a timing issue for them. For the clients that we serve, which are small to medium to semi-large businesses, it was a real tax impact that someone had to take out loans just to pay their tax bills.
Sure. Well, now that's behind us. Yep. Why don't you tell us what stood out to you most in the OB3?
I think ultimately just what ultimately made it through. I think when the House version came out and it was a 5-year 100% expensing, we thought, okay, this makes sense, because that's something that in previous bills that didn't ultimately pass, it was more of a delay, temporary relief from 174. And then when the Senate issued their version, it was, wow, this is almost too good to be true. And surely this is this is them setting a high anchor point for negotiations, and maybe the permanency would be stripped back, or the catch-up deductions would be eliminated, or the retroactivity for small businesses would be stripped out as kind of a negotiating tool. So when that ultimately passed the way that it was, the way the Senate had written it, we celebrated, because that was going to be absolute win for our clients and just taxpayers at large.
Sure. Well, I mean, I remember when the House released their version, we came out with and then the Senate released kind of some language. We actually came out with a proposed fix, so to speak, to advise our clients. And we were telling people, let's not assume the Senate version is going to happen. Let's follow the House's guidance, because that's way more conservative. And it turned out that, obviously, fortunately, the Senate version passed. What I like about it, David, is that it's permanent. It's something that for whether you're a Republican or you're a Democrat or you're somewhere in the middle, this is permanent, which is good. People can now set some policy based on R&D investments and what they dedicate to product development in the United States.
Right. Yeah. It's just good tax policy to be able to be able to reward companies for investing in research in the United States and allow them to deduct those costs immediately. It makes total sense, and to your point, it's something that both sides agreed on, and it's good that finally it came to fruition.
Obviously, so full 174 expensing returns in the 2025 tax year. So for tax years starting after December 31, 2024. What are some of the things in the couple weeks since the bill's been passed, and what are some of the things that really come to your mind and how we're helping CPAs advise their clients, how we're helping our clients? Obviously we have the large versus small taxpayers. We have the clients that did 174 and maybe they're over $31 million, which you'll explain what that is.
Right.
And how does that get fixed going forward? What's the impact of a fiscal year company? I mean, there's I see about maybe 5 issues that we're dealing with constantly as a firm in the weeks since weeks following the OB3 being passed.
Yeah, I mean, I think the big thing is just education. So acknowledging, like you said, 174 amortization is still in effect from 2022 through 2024 tax years. I think that's the biggest point of confusion right now, as we've gotten a lot of emails from CPAs and from clients. They say, oh, well, 174 is fixed. I don't have to do anything for 24. Well, hold on. It's for tax years beginning after December 31st, 2024. So to your point, fiscal year-end clients, it applies to the following tax year. So if they still have a 2024 return that's out there, that still has to comply with 174 amortization. So just having that education with the clients, just to make sure, and the CPAs to make sure that they're on the same page too, so that we can advise them appropriately on the best next steps, has been key and pretty, been the key to what we've had to do over the last couple weeks.
You mentioned earlier the significance of, when we're talking about 174 amortization, is you talked about large companies, a timing issue, and a lot of the clients we work with obviously are closely held and medium-sized businesses. Can you explain the differences in the OB3 in terms of how they look at what we call closely held businesses versus large corporations?
Yeah, so in this eligible small business provision, that would be for companies that are under $31 million, and that's measured based on their average gross receipts from the 22, 23, and 24 tax years. So if a business is under that threshold, they can qualify as an eligible small business, but just because they have that ability to qualify as an eligible small business, and the provisions are there, being able to amend their 22, 23, and 24 returns to deduct 100% of the 174 costs, they don't have to do that. The option that's available for all taxpayers, whether they're large or small, is they can either continue to amortize those 22 through 24 expenses as they've been amortizing, let the schedules run out, or they can choose a 1-year or 2-year catch-up of any of the remaining unamortized deductions. So that, like I said, those options are available for all taxpayers. The small taxpayers have the option to go back and amend 22, 23, and 24 to claim 100% deductions. But that's, again, just some of that education that needs to happen for each CPA, for each of their individual clients, and just think through the various scenarios, the various factors that they might have to consider to determine what the best option is for them.
What we've done, obviously, is interpret the tax bill, okay? And leaned on our experiences with the IRS. And we know we haven't had guidance come out. So we're filming this in the middle of July of 2025. So some things are left to interpretation and not necessarily IRS guidance. Okay?
Correct.
But given the time of year that this is, and given the extension deadlines that are coming up for the 24 tax year, let's run through a scenario. We have a client that maybe claimed the R&D credit up through 21. Okay. And they did not claim the R&D credit in 22 or 23. They're on extension for 24. They're $20 million in revenue. Okay. What's our counsel to them? How do they go back and amend 22 and 23, claim the credit, expense 174? Then how do they handle the 24 year? Based on what we know now in our interpretation. Obviously, guidance may come out to supersede what we're getting ready to say, but what's our counsel for those companies that are on extension right now?
Yeah, I mean, it all depends on, again, the individual taxpayer's scenario, but if it makes sense to go back and amend 22 and 23, if the benefit is there, we'd say go ahead and amend the 22 and 23 returns to claim the R&D credit, and then look at potentially claiming the 24 credit on the originally filed return if it's still open. Again, it could be, you could look to see, is it the eligible small business provision the best option for them, or should it be the option that's available to all taxpayers, which would be amend whichever years make sense for 22, 23, and 20, and then claim on 24, and then look to file a 3115 to be able to get into compliance with 174 and acknowledge that there were expenses in 22 and 23 that we can't go back and amend to claim, because that would be a change of method of accounting, which needs to be done via 3115. But again, going back and amending, claim the R&D credit for 22 and 23, and then filing that 3115 to acknowledge there's 174 expenses and get into compliance.
Filed 3115 on the 2024 tax return.
Correct.
Okay.
Yeah.
But I think one thing that we've discussed internally is consistency.
Mm-hmm.
And so what you did in 22 and 23, we need to do in 24 and vice versa. What 24 is, you need to do the same for 22 and 23. You can't have a split strategy, correct?
Correct. Yeah, there has to be that consistency there. Again, if they're going to apply as a eligible small business, that they would be able to deduct those expenses at 100%. Then yes, they could go ahead and, to your point, deduct those expenses 100% on the 24 return, and then through further guidance be able to amend the 22 and 23 returns to claim the credit. Or if they decide not to do the eligible small business, obviously there would still have to be that amortization on the 24 tax return with that 3115 to catch up on the 22 and 23 deductions as well.
So kind of going along with that, let's throw another scenario, because we have a lot of companies that are pass-through companies, S corps, partnerships, etc. So, I think one thing we run into when we look at amending returns, if you have 10 to 12, 15 shareholders, that's a lot of returns, especially if they file in multiple states. Okay.
That's true too. Yep.
So whether you're under 31 million or you're over 31 million, when you're a pass-through company with a lot of shareholders and file in a lot of states, amending just isn't doable,
right.
Or it's just it's super labor intensive, a lot of fees, and just a lot of other challenges that may pop up. And we have a lot of conservative taxpayers as clients, and they just say, I don't want to amend. So what we're saying is, I don't mean to ask this leading question here, but basically then in that case, whether they're small or large, we advise to get that catch-up adjustment, either take it in 25 or you can split it evenly between 25 and 26, correct?
Correct. Yes.
Okay.
Yeah. Yeah. And this, I guess, is this assuming that they have claimed 174 in the past, or is this if they have not done anything?
Yes. I'm sorry. Claimed 174 in the past.
Okay.
Yes.
Yeah.
Yes.
Yeah, for sure. If they have the tax liability to offset some of their 25 liability, if they're able to fully utilize it, that's probably the best counsel that we can have, is because we've read everything about the cuts at the IRS and from Doge and everything like that. So going back and amending the returns, even if they are an eligible small taxpayer, it might take a little while to get those refunds, whereas accelerating the unamortized deductions from the 22 through 24 tax years might help them realize benefit sooner by doing that 1 year catch up on the 25 return.
Okay. I think one of the, we touched on some of this, but as our CPA firms, the 500 plus firms that we serve across the country, what are some critical things that you have spoken with them about or think they need to be mindful of as they roll this out to their clients in the coming weeks and months?
Yeah, I mean, I think, again, it just goes back to that education and fully educating their clients on what these provisions mean and what they don't mean. We've gotten a lot of questions of, can I just expense this on the 24 return? So just knowing what the options that are available, and then also just keeping it simple, being able to tailor the conversation to each individual client. Because if there's a large taxpayer, they're likely not, they probably don't need to know about the small business provision unless perhaps they think that it might apply to them. So just being able to tailor the conversation to really hone in and focus in on what is that client's situation so that they can offer the best advice and offer the options that are actually available to them.
What is the risk? Is there a risk for a taxpayer that didn't claim 22 and 23 and 24 credit or amortize? So they came out of it kind of going back to the 23 calendar year when they're looking at their 22 tax return, their CPA calls them and says, hey, we've got to start amortizing. Let's say they claimed the R&D in 21 tax years and forward or previously. And they just put it dormant. They just mothballed it for 22, 23, 24. And they want to turn it back on in 25. Do you anticipate, I know you can't, this is all speculative.
Sure.
Do you anticipate any risk, any exposure that they've created for themselves?
There's always going to be that risk there if all of a sudden they have expenses in 25 and then they had expenses in 21, but magically they don't have expenses in 22, 23, and 24. So, any IRS examiner that is looking at that will probably be able to see, well, compare those years to 25 and 21 and say, well, what's going on here? Why this sudden decline in research to go from all of these expenses to zero? So it's definitely a situation where taxpayers need to be prepared to address that. And the way that our models are, the models that we created, it's really basically advantageous for them to go ahead and get into compliance. And it's really taxpayer favorable to be able to get into compliance and be able to have that peace of mind where, if the IRS does examine the claims for one reason or another, that's fully disclosed that they have, that they disclosed that there were 174 costs and they took steps to correct it.
Let's go through another example real quick, I think, for our listeners today.
Okay.
We have let's go large company. Let's say it's $40 million in revenue. They've averaged 22 through 24. Claimed the credit up through 21 tax year and didn't do a darn thing in 22, 23, and 24 because they didn't want to face the realities of the 174 amortization.
Yeah.
We CPA calls them, starts talking to them about it. And they said, okay, what's it look like to go back and claim my credits now? Obviously, we got to go backwards. They're not subject to the small business provision. We can't do the 280C election because they're a large company. We got to do a 481A. Can you walk our listeners through that situation in terms of what that would look like for them?
Yeah, sure. So going back and amending the 22 and 23, 24 returns, that would just be for claiming the research credit. And during that, the modified 280C provision would still be there. So, even though they can't elect the 280C, that would still be more advantageous for them to do. So amend the 22, 23, 24 returns, claim the credits, however those potential refunds might shake out. Then for the 25 return, filing that 3115, which is an election to change the accounting method to comply with 174 amortization. And typically how that's done is there's going to be a 481A adjustment. When you typically file 3115, there's either a negative 481A adjustment that's taxpayer favorable or a positive one that's IRS favorable. In this instance, it would be a IRS favorable adjustment, but that would be able to be spread out over 4 years rather than having to take that hit of the 41A adjustment on the 25 return. So that already helps a great deal because
plus you have all the credits. You have all the credits from 22, 23, and 24 also.
Correct. And also, 25 with 100% expensing in 25 as well. But then also, again, this is subject to further IRS guidance. If you're able to do this, what you could potentially do is when you're filing the 3115, you'll have the positive 481A adjustment that would have been for all the income that you should have claimed during the previous years. But then if you elect the 1-year catch-up adjustment for the unamortized 22 through 24 deductions, it's a wash. So it results in a 0 481A adjustment. Yeah. Again, this is assuming
on the 25 return.
Correct. And this is assuming that the IRS will allow this to happen and that the procedures will be in place. But then again, it's a 0 41A adjustment. You still get the credits for our 22, 23, 24, and then 25, 100% expensing going forward. You're in compliance. You fully disclose that, yes, there were 174 expenses that were incurred by the company in 22, 23, and 24, and you're able to continue on recognizing the R&D credit as the benefit that it is.
Okay. Well, let me kind of a bonus round before we conclude today's session.
Okay.
I think there are some of our listeners here, and you actually moonlighted for the past couple of years as our employee retention tax credit expert as well. Could you give just a quick update on what we're seeing in that? I know there was a moratorium on processing claims. We've done a lot of those projects. Can you kind of give our listeners just a real quick summary of where it's at right now with the IRS and what we're seeing?
Yeah, actually, there have been a lot of claims that have really picked up in terms of the IRS processing them. I know that the current IRS commissioner was a big proponent of ERC, and so that may have spurred some of the backlog, the encouragement of processing some of that backlog that's been in place. But we definitely have seen a lot of great traction with clients, taxpayers receiving their refunds recently. So, anybody that still has a pending ERC claim out there, I would encourage them to reach out to the IRS and just see if there's any action that needs to take place, because, like I said, there have been a lot more just in the last couple of months where clients have been getting their refunds after an extended period of time of a year and a half.
Good. Glad to hear that. It's a lot of clients have really been in a very difficult situation while they wait for those refunds.
Absolutely.
And then my final question for you is, we have this, our R&D practice, which is obviously one of our largest practices, been doing it a long, long time. There's some big changes coming up for the 25 filing season with Section G. Can you kind of give everybody an update on that?
Yeah, so Section G is a part of a revision of the 6765, which is the R&D Tax Credit form, part of the revisions that were started in 24. So what Section G is they are requiring, the IRS is now requiring companies to break down their expenses, their qualified research expenses by business component. And it was optional for 24, but it will be mandatory for many companies starting at 25.
And what's the threshold for those when you say many companies?
So it will remain optional for any companies that are claiming the payroll tax credit offset, or companies that are both have 1.5 million or under in QREs and under 50 million in gross receipts. So that's an and situation. So if they meet both of those, then it's optional on their originally filed returns. If either one of those is not met, then they have to file Section G. So obviously this is for taxpayers. There may not be any taxpayer, I suppose, whether they have filed for the credit historically in 24 and prior, or they have taken the pause, like we've said before. It's definitely a monumental shift in the way a lot of companies are going to have to think about how they ultimately track and report those expenses. So we're more than halfway through the year for 2025. So if there are any taxpayers out there that have not fully prepared for it, it probably makes sense to evaluate where they are now and what records do they have that they maybe need to adjust, what procedures, what processes do they need to adjust to be able to start tracking things better going forward, but then also being able to maybe reconstruct those expenses and those records for the previous to the start of 25, because worst case scenario is that you wait until January 2026 and then you're going back and you have to reconstruct the whole year from scratch. Much better to try to tackle it now and have those procedures in place to start tracking now going forward to the end of the year to make the R&D study and the R&D credit claiming process easier, an easier lift during tax season.
Well, David, thank you so much for all your work and all the insight and education you provide to our team and our clients and obviously our alliance firms. So really much appreciated. That wraps up today's deep dive into the One Big Beautiful Bill and its impact on the R&D tax credit landscape. Big thanks to David for sharing his expertise and helping us to make sense of these changes. As we heard, this legislation presents a unique window for CPAs and business leaders to revisit their approach to Section 174 and reclaim valuable R&D tax credits, while also cleaning up any non-compliance from prior years. With new rules, stricter reporting, and real cash on the table, there's never been a better time to plan. If you'd like to learn more about or talk through some specific client situations, visit McGuireSponsel.com or connect with our R&D team directly. And as always, thank you for tuning in to Let's Talk Tax. We'll see you next time.